For the economy to truly deliver security and opportunity for American workers, we need plentiful job opportunities, we need high wages, we need low prices. Prices are the current problem, but it's been decades since workers have had all three at once. No matter what goes wrong in the economy, whether it's a financial crisis or bank failures, whether it's supply chain turmoil or energy market disruption, working people always pay the price. Meanwhile, corporations always somehow find a way to increase their profits. They always find a way. Financial crisis, profits go up. Mass unemployment, profits go up. Global pandemic, profits go up. War in Europe, profits go up. Increasing energy costs, profits go up. When supply chains ground to a halt when Putin invaded Ukraine and the economy reopened and demand surged everywhere all at once, the rest of us saw problems to solve. But in many corporate boardrooms, executives instead saw an opportunity. For the largest multinational corporations, inflation has been a perfect excuse to increase profits by raising prices far beyond the costs of their inputs. The main tool that many in this town look toward to rescue us from inflation, hiking interest rates, can do little to solve that problem. It's little wonder then that when American workers see the high prices at the grocery store, at the pharmacy counter, at the gas pump, along with rising borrowing costs for mortgages and credit cards and car loans, they remain skeptical of government and its willingness to address the challenges people face. Inflation, of course, is a complex problem. The Fed's been fighting it with a blunt tool, and we made progress. Inflation is at the lowest level in the last 2 years, giving hope that the price of consumer goods will continue to decline. And despite the experts' prediction, job growth remains strong. The country added 339,000 new jobs in May. Ohio's unemployment rate, 3.6%, is the state's lowest in 20 years. Unemployment for Black and brown Americans remains near historic lows. Think about what actually means for workers in Alabama and Ohio and North Dakota and Louisiana and Minnesota and South Carolina. What that actually means for workers all over the country. It means Americans have more opportunity and choice in their lives, even in places they haven't seen a lot of options in recent years. It means people have the power to demand raises and retirement security and paid sick days and control over their schedules. It means more Americans have the dignity of work that comes with a good job that can provide for your family. And look where that kind of power for workers is taking us. Last month, wage growth outpaced inflation. That's the way it should be. Today's hearing comes at a critical time. Last week, the Fed decided to pause interest rate hikes after 10 consecutive increases and to maintain the rate at its current level. For the many of us who are concerned that further rate hikes could do more harm than good, it's welcome news. The challenge you face, Chair Powell, is to ensure that workers continue to see higher wages while also continuing to rein in inflation. In previous hearings, you've noted with justifiable pride how careful management of the economy helped millions of workers return to the job market. It's those workers who stand to lose the most if the Fed overdoes its rate hikes, loses sight of the dual mandate, and drives the unemployment rate back up. As you've also noted, Mr. Chair, increasing interest rates is not the only tool we have to fight inflation. The Fed is not the only one with a role to play. Congress, the administration, everyone in government, and corporate boardrooms must do their part. There's no reason we can't continue coming together to bring prices down. More policymakers are finally recognizing what those of us in Ohio have known for years, that outsourcing the production of pretty much everything may mean higher profits in the short term, but it won't lead to a resilient economy with a strong middle class in the long term. We've taken steps to strengthen our supply chains in hiring and been bringing critical manufacturing back to the U.S., the CHIPS Act, the bipartisan infrastructure law, a number of things. We must continue that progress instead of lowering demand, which is just economics textbook jargon for making people poorer, laying off workers, denying raises. Instead of lowering demand, we can produce more, we can build more, we can grow the economy from the middle out. It's also our first semi-annual report from the Fed since the string of bank failures this spring. Those failures were caused by the same issue at the heart of so many of our economic problems. It's the Wall Street business model. Executives lay off workers. They put short-term increases in quarterly profits and their own compensation above everything and everyone else. At Silicon Valley Bank and Signature Bank, those in charge pushed their banks to grow too big, too fast. They made risky bets. They got massive profits. Executives were paying themselves bonuses right up until the moment that at least one of these banks crashed. To most Americans, that's not surprising. People have gotten all too used to big bankers treating the industry more like a game, or maybe more precisely, an endless ATM for themselves, secure in the knowledge they won't pay any real price if things go wrong. Mr. Chairman, as Senator Scott and I teamed up on a 21-2 vote yesterday, those days for bank executives are over. Chair Powell, I look forward to hearing today how the Fed will protect American workers in the fight against inflation and promote an economy with a strong, growing middle class. Senator Scott.
Thank you.